Hello and welcome to the Trading with Ashley show. This video is going to be jam-packed with tons of information to help those of you that feel like you missed the PLTR boat. I have heard from a lot of you that unfortunately you had covered calls on your PLTR shares that you thought were safe, and then after market hours they were called away and you're sitting there with no PLTR shares and you're feeling like, okay, what next? So I have 3 strategies that I am going to take you through that will help you recover some of the money that you may be missing out on because you don't have the shares anymore. And I will teach you these in a strategic way. Now, the best part about this video is you can apply this to any stock that you feel like you missed the boat on. So naturally, the best opportunity for you is to go ahead and start an automatic buy to DCA back into your shares. But I have so many other strategies for you that will help you raise the capital to buy the shares so that you can be made whole again. So get ready, get your pen in hand, and let's get busy. The first strategy I want to share with you has to do with LEAPS. It means long-term anticipation equity securities. Why they call it that crazy name, I don't know. But it's a wonderful strategy to help double your buying power for PLTR. So let me explain. When you purchase a LEAPS, all that is a call option that is dated 1 year out or more. And if you think about it, if you were to go and buy 100 shares of PLTR, let's say at market open, it's at $35 a share. So that would cost you about $3,500 to get your 100 shares. Now with a LEAPS, you can go and purchase a call. Usually we stick with a 0.8 delta. We're going to go into this chart and I'm going to show you exactly what to look for. But if you do that, it maximizes your buying power, and they're traditionally about half price than purchasing the shares alone. But the best part about a LEAPS is, as long as you hold it, you get to take advantage of all the positive price action moving ahead. And as the option chain expands, you can add more. So I want to take you into the option chain. Let's look specifically at which ones you might want to consider for this upcoming week. The first thing I want to show you is what I had done. I think this was probably about a month and a half ago. I actually purchased some LEAPS options on PLTR. And so when I did, you can see here, I purchased the $20 call. This is not expiring until January of 2026, so it has quite a bit of time left in it. I purchased 5 of them. They're worth $13 today, but when I purchased them, they were actually only costing me about $10.80. And so you can see right here where I've already gained quite a bit of value. Now, what you're seeing right here is the loss from the pullback yesterday before the market closed. When the market opens on Monday, with PLTR jumping quite high, I should see significant appreciation on this side of the equation. So I've been doing this strategy for a while. It's a great way to make money. Let me take you into the actual option chain and show you what I look for. The way we get started with this trade is we go to the option chain, and the first order of business is expiration date. So you see up here is our expiration date. Well, if you are going to do a true LEAPS, it's a year or more out. Now, me personally, when I'm super bullish on a stock, I like to go ahead and go as far out as I can so that I can enjoy the price appreciation for even longer. The other benefit to going far out is you don't have to deal with a lot of time decay. When you purchase options, time decay is a part of the equation, and the closer you get to your expiration, the more that particular option erodes, costing you money. But if you go really far out, it's very small until you start to get closer to the expiration date. Usually you want to shut down your LEAPS probably anywhere from 2 to 3 months out to avoid aggressive time decay. So with that little option chain, I can see I could go all the way out to December of 2026. Now, you would only do this if you have a strong belief that PLTR is going to be significantly higher by that time. I personally do. So once you pull up the option chain, you'll notice puts are to the right and calls are to the left. So what we do is we look along this option chain and we want to focus on these deltas here. The sweet spot for a delta is looking at something around 0.8. So we have a couple of options here for us. We have a 0.78 delta right here at the $25 level. It's a great point because it's kind of that, natural number that people might gravitate to. Like they might decide, I'll buy this if it goes under 25, or I'll sell it if it goes over 25. So this is a really good one to consider. Also, you have right above it this $22 level. It's a $3 difference in strikes, so you might enjoy more aggressive price appreciation with this particular one. You can see it's a 0.82 delta. And then the other one to consider is a little bit higher. It's the $20 one. This is similar to the one that I had purchased, and this has a 0.84 delta, but it's quite a bit more expensive. So let's talk through the pricing. If we wanted to stick with this 25 delta, now these prices will be different Monday, and so you might have sticker shock if you open it up Monday and the prices are spiking high. So what you want to do is you want to wait until Palantir has a pullback. So watch it at market open, because you may have at market open a lot of people starting to take profit. And if they do, then you'll see that natural pullback. And then that would be the time to actually purchase this. Or if we have any kind of black swan event or anything that makes the market drop in general, then potentially Palantir might pull back. So here it is. Let's look at 25. As it stands right now, you'd pay about $1,300 for this particular option. That's a lot of money, but remember, if you were going to go and buy the shares, you'd be buying 100 and you'd be paying closer to $3,500. So you could really triple your buying power now by purchasing this, and then you get to enjoy the price appreciation of 300 shares versus 100 shares. Now, how much will this go up as Palantir starts to rise? Well, all of that information is right here in your delta. If you are looking at this, this means you will get another 78 cents per share for each dollar that Palantir rises from the time that you purchase it. So if you multiply that by 100, that's about $78. So this right here that you're paying $12.95 for, it will add another $78 to it for every dollar that Palantir goes up. Now, the flip side of that is this will reduce by $78 for every dollar that Palantir loses after you purchase it. So that can give you a sense of how you can get a better entry if it pulls back by $1, or how you will enjoy the ride up if it goes up by $1. So that's how you do it. You would just do buy right here instead of sell. You would send it to a ticket. Once you get to a ticket, it'll show you your expiration date. It'll show you your expiration price, and it says buy to open. You do one right here because this is operating on 100 shares, and then you could do a market order, or if you want to set a limit order, you'd want to go between the bid and the ask. And with a wide bid-ask spread, that's usually advisable. And here they have it populated at $12.95. So you would put this $12.95 in, and then you would make it good for the day. When you preview it, it will show you right here how much it'll cost you. And then as far as how much it will go up, you can look on an option calculator and see the potential price appreciation. We're going to go do that next. Okay, I have it loaded up here in an option calculator. We are looking at that December 18th expiration date. We're looking at the $25 call, and it's showing the debit because this is how much we paid for it. Now, when you see your break-even price right here, this is showing you at expiration how much Palantir has to be priced at for you to break even. So it needs to be at $38 to overcome what you paid for the option. I'm not at all worried about that. I think in the span of this will be much higher than that. This expiration is in 2 years and 3 months. So I think we have plenty of time for great news to come out about Palantir, plus all the buying pressure that we'll see with the S&P occlusion. So let's talk about the fun stuff. How much money can we make? Well, if you look here, if this goes up, let's say that PLTR goes up to $80 after we have been in this for quite some time. So look at June the 26th. This is June the 26th of 2026. If we're sitting at, looks like $80, then that's an additional $4,725 in your pocket. Now, if you purchased 3 of those for each one, you will be getting another $4,725. And so that's the beauty of these. Instead of just enjoying the price appreciation of 100 shares, you can triple the amount that you're getting exposure to. So this would be quite the payday and a lot of fun. Now, how do you get out of these trades? Well, since you bought it, you would sell it to get out of it. And what you might want to consider, if you're buying more than one, legging out of it. So you can maybe lock in some profit, maybe here in October, and then see if it runs a little bit higher. And then you can let one go maybe in May. And then as you approach the expiration date, you probably want to get completely out of your position at least 3 months before. Now, for those of you that like a poor man's covered call, this acts as a synthetic long, and you can sell calls against it, shorter dated. But if this stock is going to continue to run, I'd hate for you to have it shut down prematurely. So if you buy more than one and you want to sell covered calls against it to earn more money, maybe just do that with one of your leaps and let the other 2 run free. Okay, now that we're locked and loaded with leaps, I want to show you one of my favorite strategies. Now, I love selling puts. For those of you that aren't familiar with selling puts, basically you just have to have the cash to purchase the shares at the strike price that you select. Now, typically we do try to arrange our put strike price below the Bollinger Band, and we try to look at the RSI. There's a science behind it so you get the best entry. But when you're hungry to get more exposure to a stock, you usually fearlessly go in and sell at the money puts. That's what I've been doing, and I have been making so much money doing that. A lot of my Discord members have been doing the same and enjoying all the cash that's coming our way. And then once the expiration date comes to pass, one of 2 things happen. You either get the shares, which you wanted them anyway, or you get to keep all that cash. Your money is released to you, and you can use that cash to go buy shares or on another play. You can put it on another Palantir play or another play altogether. So now let's go into the option chain, and I'm going to show you what to look for if you want to use this strategy this week to make tons of money. So this is what I was talking about when I said these are so much fun, because you can get so much money if you're fearless and you're not worried about assignment. Now, typically, if you are going to sell a put, I encourage my students to wait for a red day. You're going to get more premium, and that still holds true. But you can also get some great premium even on a green day with a stock like this if you're trying to get assigned. And so what you would want to do, you can do this weekly or monthly. So let's say you wake up Monday morning and you decide, I just want my hands on some Palantir shares. I don't care if it's red or green. I just want to grab them. So you might look at the 13th. Okay, if you did that, when you go to your puts, we're a delta of about 0.2 or 0.3, that gives you anywhere from an 80% chance to a 70% chance that you'll just keep the premium. But remember, we want assignment. So what you do in that scenario, you see right here, this is where it closed on Friday. So when it opens up on Monday, it's probably got to be closer maybe to about 32, 35. I don't know. It just depends on how it settles in. But let's work with what we have right now. So if it's at 30, this will show you some potential amount of money that you will get for the stock. So if this is called an at the money put. So what you would do, instead of looking at your traditional deltas, which would put you, right here at about 28 or 28.5, we're going to go ahead and do an at the money put right here at 30. So if it was trading, right above 30, you would settle in. You would receive for this $1.09 per share, which is very lucrative because this is going to take down your pricing by over $1 if you're put the shares. Now, if you're not put the shares, if Palantir keeps running, well, then this is yours to keep. Now, I must share with you, you will have to have the cash in your brokerage account to purchase the shares at $30 in the event you're put the shares. Now, to execute this trade, you would populate sell because we're selling the option and we're going to get paid premium for that. When it gets to a ticket, you have all your detail right here that's been pre-populated for you. And if you want to sell one of these to operate 100 shares, to commit to purchasing 100 shares, you would put one right there. And then you would put your limit order in right here. This is showing $1.09, so I'll go ahead and put $1.09. You can actually put this higher if you like, and if the stock starts to pull back, it may fill. So if you look at that, you make it good for the day. When you preview it, it's going to show you right here, you'll receive $109 to execute this trade. Now on this, what you're seeing, it's only showing that it's requiring $1,483. The reason for that is I'm using margin. But if you're using a cash account, you will have to have the cash to go ahead and purchase those shares. Now, if you're not put the shares, you could just continue to do this as the price rises. If you want to do this strategy, but you definitely want shares, then you might start dollar cost averaging, and you can use this money that you're making for the premium to go and just buy the shares. And that will effectively give you the shares free. All right, the final strategy I'm going to go over with you. It may seem complicated when you hear it, but I'm making it so easy for you. And that's what I like to do. I like to break these plays down to where anybody can understand them. In fact, I have a video where I'm showing my daughter how to sell put options. I'd love for you to check it out because she's a teenager and has no trading experience, and she picked this up in 15 minutes. But what I'm about to show you is a put credit spread. Now, the reason this is a great strategy on a stock that you think will continue to rise is we can make money as long as the stock does not come down to where we started our put credit spread. This is a directional strategy, and I'm very confident using this strategy with Palantir because with the S&P 500 inclusion, there are a lot of institutions that will be forced to buy Palantir that before they never were even interested in it. And all that buying pressure should cause the stock to continue to increase. Now, there will be pullbacks, of course. That's always the case because you're going to have some people that are running the wheel on it or that are wanting to take profit. That's okay. But this strategy, I am going to take you into the charts and we are going to look at the best strike price to start this strategy on, and I'm going to show you exactly how to execute it. Let's go take a look. Now for this next play that I'm going to show you, the put credit spread, we actually do want to do some due diligence on the technical analysis because the point of this trade is you want the premium, but you definitely don't want it getting anywhere close to your strike prices as we get closer to the expiration date, especially on the expiration date. Now, this is going to be a longer dated trade. I like doing these at least 3 months out. And if I'm going to go 3 months out, I actually want to look at a 6-month chart to give myself even more security that I am selecting a safe strike price. So this is a Friday. This is the action. Again, this will change when you see it early next week, but you'll have the mechanics of what to do. So if we're going to do a put credit spread, the idea is to go below the Bollinger Band, and that's going to keep you out of harm's way. And if you want to be super safe, you actually would go under this 200-day moving average, which is 23. You just may have very limited premium if you go this low. But those are some good ideas to give you a sense for how to look at this and how to keep your trade safe. The bottom of this band is going to be right there at about 29, 28. And we know if we go below that, we give ourselves the best chance at having a fruitful trade. Going back to the option chain, I had wanted to look at a date that's about 3 months out. So let's do that now. The opportunity for us would be right here in December, or I'd like to maybe even consider January. Let's look at January because the further out we go, the more premium we're going to get because less is known about the future. Here's where we start building the trade. If we wanted to start at that $28 strike, then this is where we would sell this particular put option. Well, as you remember from the earlier example, you had to have the cash to buy those shares. You may say, okay, Ashley, I'm not interested in putting $2,800 up to buy these shares. That's okay. We're going to add to this trade where we get to take advantage of the price movement up, but we don't have to put up that amount of cash. So if we're selling the 28 one, now what we're going to do is look for one that's lower than this that we're going to buy. For this $28 put that we're selling, we're going to receive $2.62 a share. Now let's go look for a price. Let's go a few dollars down and see one that will purchase for less, and we get to keep the difference. Okay, I like this one right here, this $25 strike. This is $3 down from the 28. If I buy this one, now I am going to receive the difference between 262 minus 158 because I am selling this one and I am paying to buy this one. Now, how much can I potentially lose on the trade? What is my risk? That's where your strike prices come into play. You would take 28 minus 25. That equals 3. Then you multiply it by 100. So your risk on this trade is $300. And you would have to have in your account $300 to put this trade on. So it's very reasonable. Let's go see what this trade will yield us in premium. When you send it to a ticket, it pre-populates for you the details. You've got the same expiration date, 2 different strike prices. They're both puts. One's sell to open and one is buy to open. This is your put credit spread, or some people call it a vertical put spread. Okay, when you populate the detail, you can start to see how the trade is taking form. Here is the credit you'll receive, $1.14 a share. So if you change this right here to net credit, because we're getting a credit for the trade, and you put in the details, make it good for the day, when you do a preview, you can see right here, you're going to receive $114. Now, the reason that this is not showing 300 and it's only showing 186 is because it is taking into account the credit you're receiving. So 300 minus 114 is 186. Now, here's the fun part. Let's look at our potential return. This is amazing returns. If you look at $114 is what you're receiving, and it takes 300 to get it. So what you would do is you would take $114 divided by 300. That equals 0.38 multiplied by 100 is a 38% return in this small amount of time. I mean, it's hard to fathom that you can get that kind of money in such a short amount of time, considering that the S&P 500 will give you anywhere on average between 8 and 12% annually. So if you're going to put on this trade, let's talk about trade maintenance. As we get closer to our expiration date in January, the goal is to make sure that it is kept away from this $28. I call this the line of fire. And you don't want your money getting too close to this fire because then it'll burn it, and we don't want our money burned. So the way that you would look at this is as we continue to rise up, this credit spread, the money that we received that went in our pocket, it becomes more and more ours as the price moves away from $28. Now, if the price starts getting closer to $28, it's going to appear that you're losing the trade. However, what's most important is what happens on your expiration date. So what I like to do when I'm putting on these trades is I like to, once I've hit about 50 to 75% profit, then I close it down and open up a new one looking at fresh technicals. That will help you to stay out of harm's way, and it'll free up your buying power, giving you that extra cash for additional trades. I hope you found this helpful and that I have earned a like and a subscribe. I would appreciate it if you would do that for me. Also, share this video with somebody that's interested in these strategies, but they're just not sure where to start. As you know, from those of you that have been following me for a while, I have a lot of videos on my channel that will take a beginner literally from the beginning and show them how to do this. This will be helpful, I think, to other option traders that you know that may be interested. Okay, I want you to all keep learning. I'll help you with that. Keep earning. I can help you with that too. And I will see you on the trading floor.